Good afternoon, everyone. Today I'm chatting with Simon Marcotte from Northern Superior Resources. Guys, I thought it would be a great time to have Simon on because he recently wrote a piece about how he thinks that gold is heading to $30,000 an ounce in the relatively near future. Now, he believes that with Trump's policies, America is trying to remanufacture their economy, and we are about to experience negative real rates, and it's going to create a rush of capital into gold. We also touch on Northern Superior Resources, which is a company that he's been involved with for a few years here that has a pretty interesting project where they're trying to put together a bunch of properties in the Shabugamu Gold Camp, and they got a pretty big partner there in IM Gold. So Simon gives us an update on that at the end of the video. All right, everybody, enjoy the interview. Simon, it's good to see you again.
Hi, Steve. How have you been?
So, recently I've seen your name pop up with a pretty big bull call for gold, $30,000 gold. Walk us through your thesis. Why do you think gold's going there?
Yeah. Well, thanks for having me on, Steve. Always a pleasure to see you. And $30,000 may sound like a lot, but it's far from unprecedented. Just take a look at oil that went from $12 a barrel to $140 a barrel between 1999 and 2008. And since then, a lot of money has been put into the system, and everything seems to turn into a tsunami, right? And we've got plenty of examples. So I just think that gold is the next tsunami. Now, about this level, the last time that we went through a period of negative real rates, which I think is where we're heading, gold did just that, go to those levels. The way to look at it is look at the value of the gold reserves of the United States as a percentage of the total debt of the United States, right? So, I mean, you're familiar with stock prices that are very volatile. When a stock company is doing well, a stock's doing well, everybody is valuing the company on the basis of, today's value of the future earnings of the company. But when things go south and a stock is in free fall, then the market will focus on the book value of the company or the liquidation value of the company, right? So the way to look at it is the U.S. gold reserves are the book value really of the U.S. Currency. And if you adjust to that versus where we were in the 70s, that takes you to near $30,000 an ounce. But the last time that we have negative real rates, well, the rule of law and the strength of the U.S. institutions were never shaken. And now, obviously, that's a big question mark. What is happening politically and a global political reshuffle. So I think we are about to get there. What is going to trigger that is the real rates going negative. So the reason why gold stocks have yet to perform, I mean, if they're just starting to get a bit of traction, the junior stocks have seen nothing, no action at all, despite the price of gold's been going very strongly. That is simply because the real rates have yet to turn negative. But when they do, all these juniors will absolutely catapult to very impressive levels. And the market hasn't forgotten about those. We had an appetizer or an early taste of this in the first few months of COVID. You had real rates that went negative, and the junior gold stocks had performed tremendously. So imagine now several years of negative real rates and what this can do, right? Because I mean, if the real rates are positive, it doesn't make sense to own gold, generally speaking, right? The whole world have money in bonds where you make more money with the interest than you lose with the inflation. But when real rates go negative, that goes into reverse. To owning bonds destroys value. So gold becomes the vehicle where you can protect yourself, and actually you can borrow to buy gold, right? So just a tiny bit of asset reallocation from bonds to gold can be extremely explosive. Now, Steve, the reason why I think that we are heading towards a long period of deep negative real rates, I think have been, telegraphed and printed, and you just need to look at the right thing. There is two things that I'm looking at. First, the Trump administration's famous Project 2025. And second, the paper published from Mr. Stephen Marin, who is now the chairman of President Trump's economic councils. So first, on Project 2025, if you look at Chapter 24, there's something that is of massive importance there. And they're talking about what they want to do with bank reserves. So a bit of history there. If we go back to 2008, because 2008 had some lasting implications, right? So before 2008, when the Fed wanted to have an impact on the yield curve, what the Fed would do would be to simply, conduct open market transactions, and it would have an impact on the yields of the curve. But following 2008, there's so much money that was printed, as you remember back in 2008, that the Fed had to find a new way to have an impact, because those same open market transactions wouldn't have much of an impact anymore. So they passed a new law back in 2008 in order for the Fed to control rates. And the way they did it is that they allowed the Fed to pay interest on bank reserves. So they printed a lot of money in 2008, but most of that money, or a lot of that money, was parked into the balance sheet of the banks, just to calm everybody down that the banks were not going to crash. But to make sure the banks would not lend out that money, which would have been extremely inflationary, they started to pay interest on those bank reserves, right? So if Bank of America, for example, is getting paid 5% by the Fed for this money, they're not going to, turn around and lend out that money for John Doe for 4%, right? It makes no sense. They'll just keep the money there. But what Project 2025 says, I think page 735, but chapter 24, it says that this should stop, and you know what? It should probably stop because it's a big transfer of wealth from Main Street to Wall Street. But if they stop paying those interest, then that money is going to enter the system, and it will either increase inflation or it will collapse the yields. Either way, it is the real rates they're going to come off significantly, and the real rates going down obviously is good for gold. Now, the second point, Steve, is the paper from Stephen Marin. And you know what? Stephen Marin was on CNBC about a month ago saying, China is going to have no choice but to eat the tariffs. And I wake up today with a quote from President Trump saying the same thing, which to me speaks volume to the influence of Steve Marin within the administration. And Steve Marin published a paper which is clearly the blueprint of what the Trump administration is implementing. And that paper was published in the few hours after the American elections, a few days, but very, very, very shortly after the election. And Mr. Marin proposes some extremely draconian tools to lower yields and lower the U.S. dollar. And we're talking about, start with tariffs, put them high, and then negotiate lower tariffs with other countries in exchange for measures taken by foreign countries to boost up the value of their currencies, right? So that is to expect next. But then the paper doesn't stop there. Mr. Marin talks about, like a user fee, for example, which would be an extreme measure. But he's suggesting that, let's say that you are in Japan and you own a U.S. bond that pays 4%, the user fee would be so that the US would pay you only 3% and keep back 1% as a user fee. That is a default on the US debt in all but names. Another thing they want to do is to force an increase in duration of the bonds owned by foreign countries, where either they say, well, the bond you own will now mature a lot more down the road, or we're forcing you to buy a longer bond and sell your short bond. All of that would get the foreign countries to carry a lot more debt. Not something they're going to be happy with. So it is all of that that's behind what you've heard about the potential Marilago Accord, which is an analogy with the Plaza Accord of the 80s to lower the value of the U.S. Currency. This is what we're talking about, behind this potential Mar-a-Lago Accord. But all of this are extremely serious policies that might be implemented, and I think you're going to see yield come off or inflation go higher. It's one of the two or a combination of both. But at the end of the day, the real rates are going down and gold's going to go up. And at the same time, all of these policies will be very bearish for the US dollar, which, as you know, is very positive for gold. So we're heading towards an unprecedented period that I think the market has yet to wake up to.
Okay, so there's a lot to digest there. Just so that I'm sort of maybe summing up what you're getting at here is that your belief here is that the U.S. is looking to devalue their currency in the coming years, and what we're going to see here is the stuff around us is getting a lot more expensive. That while the interest rates, they don't really go up, the Fed starts playing games with how they structure treasuries, such that they'll embed certain user fees so that the rates that we see aren't actual, like they're not the actual real rates. So technically, on paper, it might not be real rates that are negative because they're going to have these embedded interest rates in them. I think we both can agree that the CPI data might be very much manipulated so that we don't actually see what the real inflation rate is. But it's going to be unquestionable as people look around and they see that everything's getting more expensive, and there's no way for them to just keep up via buying bonds. They're just going to be losing out. So they're going to have to turn to some sort of hard assets to try to keep up. Is that essentially?
I think we'll see actual negative real rates. We've seen them at the beginning of COVID. We've seen them in the 70s. We've seen them during World War II. I think this administration is looking to induce war times financial conditions in order to to force a remanufacturing of the of the U.S. Yeah, I think things are going to get as strong as actual real negative real rates.
It's funny, this morning, someone forwarded me a note from the rating agency Fitch, sorry, and it was in regards to Canada's outlook with a new prime minister taking over here, Mark Carney, and it discussed how if the Liberal government moves forward with their spending plan, Canada is at risk of losing their AAA bond rating. I got a chart in front of me here that shows that Canada is actually one of the last countries standing with a AAA. It's basically us in Germany. When we think about deficit to GDP spending, most countries in the G7 are hovering around 5 to 6%, whereas Canada's still in that sort of approximate 3% range. Germany's sub 2%, but I just kind of think that someone like Mark Carney's looking at it and he's going, well, they're all running 6% deficits
That's
to
right.
GDP. Why can't I do that? And I think that just from my viewpoint, when Ben Bernanke said the words quantitative easing out loud, everything changed. And it's like those metrics of austerity or fiscal responsibility have basically gone out the window. And we saw it, right? Like with Doge, Elon Musk and Trump, they tried to rein in spending. They haven't. Spending's now higher than where it started. But basically, the U.S. Um, the deficit was already out of control. COVID happened, and then the deficit just ballooned, and they've never been able to rein that back in. And it looks like the rest of the world's saying, "Well, if you guys could do it, why can't we?" And
That's right. That's right. But I mean, I'm not the one that's gonna be the one, screaming fire that the world's about to end because of debt level. Yeah, debt is high. Yes, those deficits are not sustainable. But let's not forget the amount of wealth that has been created in the last few years, right? So you have 36 trillion of debt in the United States. And the COVID stimulus that started just 5 years ago triggered a wealth creation that's been unprecedented. So I'm not talking about the staggering amount of money that's on the balance sheet of Apple and Amazon and that sort of thing. I'm talking about only the wealth accumulation that you've seen in the households. Only in the last 5 to 6 years, you had $50 trillion that has been created in wealth in households. 50, which is more than the entire U.S. debt, right? So when but yeah, a debt of a country is not based on your wealth. It's based on the GDP ratio. I get that, so that's why I'm saying those deficits are not sustainable. But there's also this big amount of wealth that's on the side. And that is what is making the current market volatility very worrisome, because it is that wealth creation that kept the consumer going, right? And now that wealth bubble that we're in is at risk of bursting. So if that bursts, the consumer disappears. The tariffs are killing trades. There's no doubt about that. The banks are not lending, so there's very little investments, and government spending is the only thing not going down, as you pointed out, right? So if you look at the GDP, all of these variables, right? GDP is government spending, investments, consumer, and trades. You only have the government that's not going down. To me, a recession is already in play, and if anything, that will get yields lower. And the other point, Steve, is if all of this, recession and all of these draconian tools that I'm talking about from, Marin's paper and Project 2025, if they're being deployed, but the world says, you know what, we're going to take opportunity to sell all those bonds. Well, I don't think that's going to be the case. But if that would be the case, then the US dollar would suffer even more, which is extremely bullish for gold. So there's no path forward here where I see a scenario that is bearish for gold.
so, do you think that it's going to take something like in terms of central banks determining, like, hey, we've got to peg our currencies to gold, or do you think that we've just got all this wealth on the sidelines that's just going to push it up organically?
For gold?
Yeah.
So, I mean, the reason why gold stocks have yet to move and to follow gold is simple. I mean, real rates are still positive, but they have yet to come down in any meaningful way. So that's why the equity market is not paying for the value of gold where it is, because gold shouldn't be where it is. Gold has been going up now because central banks have been buying, right? And they're going to be buying a lot more, right? I mean, their average gold holdings are still far below where the average of where it has been historically. So central banks have been buying, and Asian investors have been buying, right? Especially to hedge versus the real estate volatility in China. I can't help to think as well that anybody in Asia, when they saw the yen fall off a cliff, thought, hey, something's going on here. So they bought gold. But the Western investors, really where the money is, American investors, European investors, they haven't been buying gold in any and that's because real rates are not negative. But when real rates do turn negative, the Western investors are going to start buying gold. And that is going to be in addition to central banks that will keep buying gold. So gold will accelerate very rapidly when that happens. But then for the Western market, now it will make sense for gold to go up. And that will make sense to be buying gold stocks. And you're going to see a massive catch up to the current value of gold. And you're going to see M&A going from, a weekly thing to an hourly thing at some point when this happens.
How negative do you think rates are going to get? Are you talking about negative 50 basis points here, or are you talking like?
I don't want to comment on that. There's too many variables, Steve. I'm not going to say that I see the future to that extent. But I clearly see that this is what this administration is looking to do, to induce wartime financial conditions in order to remanufacture the United States. Will it work? Maybe, maybe not. But it doesn't matter. Gold's going to go up.
When you say remanufacture the United States, what do you mean by that?
Well, that's what is driving a lot of the political dynamic of the Trump administration. It is to bring back manufacturing, especially from China, to the United States, right? To make things. The United States is very good at providing services to the U.S. and to the rest of the world, but they want to make things, as Senator Rubio is saying. Now, in order to bring manufacturers back to the United States, you need a lower dollar.
Okay.
At least that's how they see it.
Yeah. Do you think that so it is such an interesting time, right? Because right now, if you watch a lot of the mainstream financial media, they're talking about how Americans in the next 2 weeks are going to start going to stores and shelves are going to be empty.
Hmm. Hmm.
There's going to be a lot of anger towards Donald Trump. We're already seeing his approval rating has plummeted. You think that this is just a Donald Trump thing, or do you think that this is future presidents are going to move forward with this policy? You think Trump's going to be able to actually move forward with this policy? I mean, he's already got the CEOs of Walmart, Target, Home Depot, the automakers all banging down his door, begging him to stop. You think that it's actually possible for him to continue to follow through with this policy?
It is a moonshot. I'd like to state, I think that what President Trump is trying to do to remanufacture America, I think it has merit, right? I mean, when people say, well, what we're going to doing, sewing jeans for $3 a day. No, I don't think this is what we're looking at. What I see is AI, a combination of AI and robotics, which can really work in tandem, and those two technologies really seem ripe for a massive disruption technologically that could take us into an era that we just can't imagine right now. So that could be triggered by a remanufacturing of the United States, right? Where robotics would be all around us, and that would evolve into applications that we can't think of. So it is a moonshot, like going to the moon, but all of these moonshots in history has been driven by the U.S. government, right? But for all these moonshots, the population was behind them. And you're not going to get the remanufacturing of the US if the corporate world is not behind the idea. As you mentioned, there's a lot of companies that don't seem to want to get on board, which makes this moonshot, risky.
Yeah. Well, I mean, they've always done things a certain way. They've got infrastructure set up to basically their entire business is built around importing cheap stuff from China and putting it on the shelves of their stores. And we're not talking about small businesses here.
That's
Um,
right. I mean, if
and
you want to stop doing that, they just can't stop. They just want to, if they just stop printing money, get right now. They print money, give it to their people, and people turn around and buy stuff from China, and we're blaming the Chinese. So it'll be, but Steve, very interesting days ahead. But we are in the right business at the right time. I can't imagine a better scenario for gold.
Now, you're obviously talking to all sorts of investors in the mining equity space. Have you noticed it pick up at all over the last few months with, I mean, gold has had, it's basically had a rip your face off rally, as we call it. It's gone from let's call a spade here. Over the last 4 years, it's gone from under $2,000 to over 3,300, hitting, I think, 3,500 at one point. That's a pretty significant rally. I'm curious, is is the interest in what you do, raising money for a mining company, picking up at all?
Yes, absolutely. There's no doubt about that. I mean, deals are getting done. The terms are better. You have a lot of M&A that is happening now. You know, when people don't want to write checks into the industry, it's not because they don't see the value, is because they fear the next round of financing may not happen, right? And now that you are starting to see M&A picking up, people are much more comfortable making investments in the space because they're not really worried that the financing that's going to be required in 2 or 3 years is going to be difficult to accomplish. So this is coming. We're seeing a lot of money coming from generalists, from fund managers, international investors. People are a lot more interested. Is it a frenzy yet, or where people are just jumping on anything? No, it's not. I think we're gonna get there. We're gonna get there and pretty soon, I think. But it's starting. You know, I think the happy days are here again. I can hear the drums beat, and we're starting to see stocks react to press releases, react to drill results, which we haven't seen in a while. So yeah, the sector is turning. But what you need for these stocks to catapult is real rates that if they don't, that turn negative, which I think we're going to see.
So let me finish on this note here. We've had you on in the past to talk about Northern Superior Resources, which is your baby. You guys have done a pretty nice job of consolidating some really interesting properties in the Shabugamu Gold Camp.
That's right.
What can you tell us since we last spoke? What's happening this summer? If I were an investor in Northern Superior, what do I think, or what should I expect out of the company this year?
Yeah. So I mean, the camp is really accelerating, right? So just to remind you, the camp of Shibugamu is a new camp, right? That's been really transformed by the discovery of Nelligan, which was the discovery of the year back in 2019. And what we did is that we took advantage of the dark days of the sector in recent years to consolidate the Shibugamu Gold Camp. So now between Northern Superior and IM Gold, you have 12.4 million ounces that have been defined already. And that's going to keep growing a lot. With the work that I Am Gold's doing, the work that we're doing, there's just still an enormous amount of blue sky in pretty much all of the projects in the area. And if you know of another camp of that type of size that is not controlled or outright owned by a super major, let me know because I'd like, I'd care. So I mean, this kind of opportunity doesn't present itself very often, but there is a particular attribute to this camp, which is the reason we got involved there, is that all these deposits are so close to one another that they can feed the same mill, right? So it's a perfect hub and spoke, as we call it. So if they can, all these deposits under one roof, or one corporate structure, then they can feed the same mill, and that creates an enormous amount of value. So if you go back 3 years ago, all these deposits were owned by 6 different companies, and now it's owned by either IM Gold and Northern Superior. And we feel strongly that our asset not only provide a lot of blue sky for size, but in particular our Philibert asset we see as the starter pit of the camp because it has a higher grade. And when you look at this type of bulk tonnage operation, just like the Côte Lake mine that IM Gold is almost done ramping up now, when you look at bulk tonnage operations like this, the key is the payback period, right? So the profitability of the first few years is absolutely paramount. So Philibert provides for a higher grade and also a very strong metallurgy. So you get a lot more gold for every ton that you mine and process. So we feel strongly that Northern Superior owns the key to the camp. And I think at Shabugamu Gold Camp, I mean, obviously we've been the driving force of the camp in recent years. We're just completed 20,000-meter drilling program. So still a lot of results to come. We had some very, very strong results already coming out. Just to give you a sense, so our resource on Philibert is just shy of 2 million ounces right now, and it's within a pit of 3 kilometers. Well, we've hit, big hit 200 meters from the pit, 750 meters from the 800 meters from the pit. So clearly the mineralization continues a lot. And we're also getting a lot of high grade at the bottom of the pit, and potentially even underground with high grade intercepts. So our assets have a lot to grow, but also IM Gold has been very active. And they published a new resource on Nelligan, which is now about 8.3 million ounces, but growing rapidly, still out of a lot of size to grab there. But interestingly enough, I think the months ahead are going to be interesting because, I mean, IM Gold, right? I mean, IM Gold went through some pretty rocky years when they started to build Côté, right? I mean, their balance sheet got pretty stretched. They had to sell their international assets to continue funding the build of Côté Lake in Ontario. And it's a company that, went through some tough time. But now it's completely turned around, like I've rarely seen. So coincidentally, with the appointment of Renaud Adams as CEO, now the company can't seem to do anything wrong, right? And the stock has been doing spectacular. Just in the last 12 months, it went from about $3 to above 10. And Côté Lake now seems to do a lot better. And we've seen the CEO of IM Gold, Renaud, buy recently something like $250,000 worth of stock. So I think the confidence of the ramp up of Côté Lake remains high. But when Côté Lake is on full cruise control, then I think IM Gold will turn its focus, and just as importantly, a lot of its narrative will become about Shabugamu. Like their main analyst, and I say main analyst, National Bank, because they were the lead underwriter for IM Gold's $300 million equity financing that allowed the company to buy back the 10% of Sumitomo. The analyst at National Bank said Shabugamu is the next stage of development for IM Gold. So right now, I think IM Gold continues to really focus on Côté Lake. They want to make sure the market sees that they are really focused on de-risking Côté Lake. But once the de-risking is done, then there's no more shareholder value to be created by that de-risking. The shareholder value will be created with the growth, which is going to be Shabugamu. So as soon as Côté Lake is fully de-risked, the narrative, I think, of IM Gold will turn towards Shabugamu, and that'll put a spotlight on what we've been doing. And the same analyst at National Bank also mentioned that IM Gold could welcome a joint venture partner for the camp, which also could really give a boost in value for that camp.
All right. Well, Simon, thanks very much for hopping on here. I appreciate you putting your neck on the chopping block, as they say, when it comes to throwing out a gold price target. Hopefully, for us gold bugs and people who have been big believers in precious metals, we see that sooner than later, just because it almost kind of feels. I know that's not necessarily a great thing for most people who aren't exposed to precious metals, but I have to say, for the sanity of those of us who have been in this space for the last decade, to actually kind of see our thesis play out is, I guess we could say, bittersweet. It is nice to see happen, and I always appreciate you coming on here and giving us your thoughts. And let's do this again soon.
Your best, Steve. Thank you very much.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Guys, also let me know what you think in the comment section. Thanks for watching, everyone.